This is Dana Samuelson with the American Gold Exchange. You're listening to the Average Joe Finances Podcast with Mike Cavagioni.
If you're watching this on YouTube, make sure you smash the like and subscribe buttons. If you're listening to our podcast, go leave us a 5-star review. All of our links can be found in the video description or show notes below. Hey, welcome back to the Average Joe Finances Podcast. I'm your host, Mike Cavagioni, and today's guests are Larry Kriesmer and Bernard Surovsky. Larry and Bernard, I'm really excited to talk with you both. We had a great conversation pre-recording, so this is going to be really fun. So welcome to the show.
Thank you.
Hey, oh, look at that. You guys are in sync already. That's perfect. All right. Hey, I want to kick this off the same way we start every podcast episode. So the audience can learn a little bit more about the both of you as I did before we hit record. So can you share a little bit about yourselves and share your story? Who are Larry and Bernard? And actually, we'll go in order. Larry, if you can go first, and then Bernard can share his story.
Fair enough. So Larry Kriesmer, I was born and raised in the Middle East in a little town called Dhahran, Saudi Arabia, where Desert Storm was our neighbor back in the day. That was a great experience. You don't really know how unique it is until you get a chance to look back on that. But as I told you during the sort of preliminaries, it was like growing up in a small rural town in the U.S. We had our own little league teams and bowling alley and grocery store and golf course and that kind of stuff. So it was, I say I was born in the 60s and grew up in the 50s because it was a very small town experience. But it really did frame me in a way that I think I get a different look at things than a typical person might have. How about you, Bernard?
I grew up in Cape Town, South Africa. I like to tell people I live in America by choice. I know what a wonderful country this is. Growing up in South Africa, I have to admit at the time that when I grew up there, it was an incredible place to grow up. Just in terms of the natural beauty, it's still magnificent. Again, similar kind of the time period that both Larry and I grew up in, it was simpler times is the way I'd put it. But I had an incredible childhood. And I'm thrilled to be in America, and I'm more than elated to be in San Diego. So, in fact, I tried living on the East Coast for about 3 months. It just wasn't for me. The weather was just too much. So ended up in San Diego and not going anywhere from here. So that's it.
Awesome. Yeah, awesome to have you guys. And both of you growing up in two very different areas, very far away from where you are now, which is pretty amazing. But Bernard, look, I grew up on the East Coast. I will say that the food there is pretty good. So I'm hoping that you had the chance to have some pizza on the East Coast.
Oh, definitely. There's two things I love on the East Coast. It's the people and the food. And so I ended up,
awesome.
So my wife is an East Coaster. And of course, we managed with the food. The food's improved a lot out here, but it was the weather. The weather didn't. I grew up in Cape Town, South Africa, very Mediterranean climate. Come to the East Coast and you get a snowstorm. It's like you got to go outside and shovel snow. It's whoa, baptism by fire. So
San Diego, you're going to get that really nice weather, and the food there's great too. I love the food in San Diego, but
get better all the time too.
Exactly.
Yeah, we didn't come here to talk about that. So we're here to talk about what you guys are doing, right? Looking at your backgrounds and your story, the way you've grown up, or I would say grew yourselves in the financial field, right, or investing field is to where you're at today is pretty amazing. So I want to jump into that. And I want to talk about what you guys do that's different than a standard investment firm or people that manage portfolios. So if you would, can you guys share a little bit about that?
Yeah, Bernard, go ahead and give them the first run.
Yeah, so basically, Larry and I, we both grew up in this business in the late 1990s, and we got to experience that whole market drawdown from 1999 was great. And then 2000, 2001, 2002. And it became apparent to us that this idea of trying to buy a little bit of this and a little bit of that wasn't getting the job done. And so we were looking for ways to try and improve the investor experience for our clients at the time. And to be able to sit across from someone and say, hey, markets were down 20, we were down 18, doesn't feel so wondrous. and then to say, oh, we've never had 3 down years in a row. And then, of course, you get the 3rd down year. It's not a very heartening feeling. And you're really scratching your head about how can we do this better. And it wasn't until Larry made a comment to me somewhere in around 2005 or something. And he said to me, there's nothing to stop the market from dropping 50% in a very short time period. And I was like, nah, It was that kind of, he's right. There is nothing to stop the market from dropping as much as you could possibly imagine over a very short time period. And we've experienced it. He was probably about a year or so early with that prediction in 2007. But by the time 2008 came around, we had experienced exactly what Larry saw coming, not even with any kind of foresight, other than just a random comment. And it got us rethinking the way people should be managing money. And it's this whole concept of sequence of returns that causes people to make dramatic errors. Mike, you might be familiar with the concept of sequence of returns, where if you're down 10%, you've got to go up 11. If you're down 20%, you have to go up 25. And of course, if you're down 50, you have to go up 100. And the market doesn't go up 100% very often in a short time period. So what you're giving up is the time to recovery, which can take a while. And that's the one commodity or the one thing we can't get more of. It's a very limited amount of that. So it got Larry and I thinking about a different way to manage money. What if we could take the bulk of the money and put it into the safest asset that we know of, namely US government treasuries, short maturity, 1 year or less, and then take a small amount of the investment and put it into a very high risk investment, but it's a very measured amount, hence the name measured risk portfolios. So we discovered that using options linked to the S&P 500, or what's called a derivative linked to the S&P 500, would give us the kinds of returns that we needed. Now we just had to measure how much of that we had to put into the portfolio in order to get a performance that was in line with a 60-40 portfolio, a 100% portfolio, an even more levered portfolio. So it's just, imagine having a dial. We can just dial it up or we can dial it down. And that's what we do. And it was such a incredible experience. The first time we did it, it was, oh my gosh, this is going to work. And it's basically just driven by mathematics. And that's what it is. And it's a way to give clients a complete certainty as to how bad things could possibly get. And we limit it on the front end of the investment rather than on the back end or during. We up front how bad this can get. Are you comfortable with that? Yes, let's go. I'm not. Okay, let's turn it down a bit. But obviously you give up upside. So that's what we do.
Yeah, that's fantastic. And as you're stating there, no matter what you do, there's always a risk, right? And
Correct.
How much risk do you want to take? And that's how you're going to dial it up and down. But for Larry to make that comment in 2007 and then the housing market crash in 2008 and how that impacted the market and just the world, really, it's funny that you make a comment in passing like that, Larry, because I think, especially if you weren't even making a prediction, you were just making a comment about how this can happen, and then boom, it happens. Are you the reason it happened, Larry?
No.
You
It's
do some voodoo or something?
Yeah, it's a weird thing though. But really, the issue for me was realizing that the traditional approach to trying to build a portfolio that has some sort of safety in it was this standard diversification, where you're trying to add in a wedge of various and hopefully non-correlated investment strategies that don't all go up or down at the same time. And the flaw with that is we're looking backwards for performance metrics. It's not predictive. It's only, all we can see is what's happened. And what we've learned in just real facts is that those types of portfolios perform really well during normalized markets, right? So when things are just average, then having a different allocation to domestic equities and foreign equities and small cap and mid cap and large cap, there's enough variety in there that you can harvest gains when certain sectors are high and use those gains to buy sectors that are low at the same time and create a buying low, selling high opportunity within a portfolio. And then along comes a crisis, which isn't happening all the time, but happens often enough that we feel compelled to have a pretty good slug of bonds in the portfolio to help us have some sort of defense against that. But the reality is that when the crisis comes along, all those formerly non-correlated assets can quickly turn correlated, and they don't correlate up. They always correlate down. And in that moment, when a client or even you as an individual investor are questioning, are we at the bottom? How much worse is the beating going to be? If you own a series of diversified holdings, you do not have an answer, because there is no limit to what those positions can drop. Even after something's dropped 50% and your $100 value is down to 50, that doesn't assure you that there's only 5% more to go. It just means that you're now at 50 and you can still lose 50% from there. That's the brutality of a position that you hold that doesn't have any kind of base. So this model of how are we going to do something different, it can't be done by just adding another wedge of diversification. There is no new thing you can add. And that's what Bernard and I struggled with for actually a couple of years prior to developing this idea, that we tried momentum plays. We tried hiring other managers that followed charting patterns. We used the engineered products that were coming out then that would move 2 times the direction of the market in the opposite direction. We were really trying hard to find something that would work. And it was this model, and we didn't invent it. This is something that the insurance companies came up with first in a structured note, and they were offered in indexed annuities that allowed for a credit if the market went up, but no loss if the market went down. And we were just fascinated by how is that built? And that's what we started to study in like 2004, 2000. And the math of it made tremendous sense. And Bernard and I think probably more me, I am not able to or will never understand when the market's going to go up or down. The idea of trying to figure out what's going to happen over the next 6 months is, I think, just impossible. But when you look at the distribution of returns over a long period of time, you just see the S&P goes up way more often than it goes down. And you have to be invested in it in order to get it. But when it does go down, look out, man. It goes down fast and hard, way faster than you go up and way worse than you think is possible. So this new structure that we have, where we have 85% or 90% or 95% that in our privately managed accounts is done at a client decision level, that gives the base at which you don't have to worry about that part of your portfolio, because we're not even subject to credit duration risk or interest rate risk, because a short duration treasury like that is not going to have much movement in response to interest rates. And then we need something, as Bernard mentioned, really volatile, not just like a little bit volatile, but we go way off the scale and we use derivatives. And those derivatives are designed to move at something like 8 to 12 times the speed of the market in response to the market's movement. So we're looking at things that can go up 10 or 12% in response to a 1% move. And also that means they can go down 10 or 12% in a 1% move. So we want that super hot volatility, but in a defined amount.
Yeah, and that makes perfect sense. And I think something that you mentioned that I want to point out is how this strategy originated with insurance companies, right? And I know for like whole life insurance and index universal life, I know that they do that as well, because I have an index universal life insurance policy. And I do know that there is a cap where it won't come down past a certain amount, but I also am capped on how high it can go.
Yep.
So I'll get that credit, but a cap, I think at 12 or 14% or something like that, but I'll never go below 2%. Right.
Yep.
So yeah, so that model is very safe for investors, right? And it gives you more of that confirmation or reassurance that you're not going to lose on a downswing. So how do you guys take that model and work that out for your investors now?
That is going to generate something that is a pretty good bond return, but it won't equate to a equity-based return, because all you have to do is, because there are zeros that are going to arrive, or 2% are going to arrive when the market's going to be negative or flat. When you add those in, you bring down the average return on the equity of the overall portfolio to something that's more modest. What we do is we actually allow for loss. So our portfolios we really don't have any people in zero risk portfolios where there is no loss potential. We ask them to realize that we're going to expose you to a 5 or a 10 or a 15% loss level. And in exchange for that, we're able to put more of the capital into the option engine. And as a result, we don't ever really have a cap. We have more of a participation ratio. So in our growth model, which is typically between 12 and 15% allocation to options, that means you're facing roughly a 12 to 15% drawdown risk over about a 1-year period. We're able to either keep up in most cases, or in some cases even outperform the S&P 500. So when the S&P has a big year in 2019, maybe it's up 31%, our growth models outperformed that. When the S&P is up 25% last year, the growth model delivered a little bit more than that. And we're doing it at the same time with about 85% of the portfolio in treasuries. So had things gone bad, like they did in 2022, then we're in a situation where the portfolio loses its option sleeve, but it wouldn't have been worse. So I think the S&P finished down about 18% in 2022. We lost our option sleeve, which is about 15%. But if the S&P had been down 28% or 38% or 48%, we wouldn't have had a materially different outcome in our structure. So we don't have the whole point for us is we don't want to have a cap in a product that is labeled as a equity type participation. So that's what really differentiates us, and that we're actively managing that portion on a daily basis. So most of what you have, I think, Mike, would be those point to point, usually 1 year or 18 months or something like that.
Right. Yeah.
What we do instead is we take a portfolio and we allocate, let's say, out of a $100,000 portfolio, $15,000 goes into options, $85,000 goes into treasuries. If 4 days from now, the portfolio has responded to a 1 or a 2 or a 3% move in the S&P by going up maybe 15 or 20 or 30% on the options, we're now moving the entire portfolio up to $102,000 or $103,000. And we'll sell that now $18,000 or $20,000 option piece, and we'll redeploy 4, 3, 5, whatever the gain was, into treasuries and bring the treasury balance up to $86,000 or $87,000 or $88,000 and redeploy the capital out into a new option tranche. And by doing that, we're constantly raising the treasury balance, the safety balance behind us, behind the gains, so that we're not in a position of giving all those gains back. Because otherwise, people that bought the S&P at, let's say, 2,500, wrote it up to 4,000, and then have a crisis, can go right back down to 2,500 and give it all back. And that's what we're trying to do. Is one of the acronyms we have for MRP, or measured risk portfolios, is also making real progress, because we're not at risk of sitting on a fat gain only to watch it all evaporate as we have a pullback.
Yeah, I love that, Larry. That actually makes a lot of sense, taking those gains and putting it into treasuries. It's making the safer side of the investment that much stronger, but also at the same time, the treasuries are still giving you a small yield anyway. So by increasing that, you're increasing the overall gain of the investment. So I think that's pretty incredible. And I don't think a lot of investors even think about it that way, right? When you go and you invest into a safer investment and you're going into like ETFs or anything like that, you know, you feel like it's nice and it's diverse, and everybody talks about having a diverse portfolio, right? But where do you readjust your balances, right? Where do you say, okay, it's time to go ahead and adjust how much I have here and how much I'm going to have here, and just redo your portfolio? But a lot of people don't talk about that, right? I think it's very interesting that you have your set amount, that this is where you're at, okay? And then we're going to take all the gains and we're going to put that into the treasuries. Now, what about when you have a loss? Let's say you have that 100,000 and you come down to 85, right? You have a 15% loss. Do you back that up with some of the treasuries, or do you just hold there until you get it back?
It's a great question, and it's a question of when does that happen? So I'll give you some historical context. During COVID, at the early part of the COVID year, the market went up and we went up. And of course, come February, March, the markets collapsed and was down, I think, 35, maybe 45%. And we had dropped in our options that we had paid, I'm just picking numbers now, in the low double digits or the mid double digits, $30+ for, were worth, in some cases, I think, pennies. They had evaporated. And we didn't do anything with them. We didn't sell them. We didn't have to go dig back into the principal of our treasuries. We actually had a little bit of dry powder to actually buy more. So we were able to do that. And by the end of the year, I believe we slightly outperformed the index by the time the year was over. Now, switch to a year where the market's down 15% and our options do evaporate, and we get to the end of the year and the options are worth nothing, then we have to dig back into that treasury stash to redeploy. So we don't have a choice for that. But I do want to add that we talk about the 15% allocation to options. That's at the beginning of the year. The remaining 85% that's in bonds is earning interest and will take us back to something closer to 87.5%. And possibly somewhere in that ballpark. I don't want to be too specific. But what I especially love about the way we've built this portfolio, it's the asymmetric risk-reward ratio, where more often than not, if the S&P can go up 50%, it can also drop 50. We can drop 12.5, but we have unlimited upside.
Specifically on the drawdown, we try and buy our options with about a 1 year duration on them. So we're not doing something with a 2 weeks or 5 days to go.
Okay.
It gives us
definitely have a lot of time.
Right. Gives us plenty of time to weather in most cases, a dip and then a recovery, right? And so during the dip, the strategy becomes very passive because we just allow the options to start losing value. And there's a ton of math involved in what we do. And the primary math is that options, I'm going to get a little geeky here for the people that are maybe a little technical on options, but options have this thing called delta, which is a participation rate. And it's the rate at which they move relative to the underlying or the theoretical pace at which they're going to move. And let's just argue that, or say that we have a 50% participation rate in an option that's at the money or the strike is at the money. When that market starts to rise, that participation rate will go from 50% to 55% to 60 and 65%. And as it gets higher, as the market goes higher and the strike becomes either at the money or in the money or below the money, the gain rate accelerates. And the opposite is true as the market's declining. As the option gets further away from being at the money, that participation rate declines from, say, 50% to 45 to 40 and 35. So it's wonderful because on a declining market, the options decelerate in the participation of those losses. And in a rising market, they accelerate in the participation of the gains. And that fulcrum is what we ride. That's what you're paying a firm like ours to do, is to manage that component. And we are looking at this daily and monitoring what's happening to the portfolios. And if the sales needs to be trimmed, we trim the risk. But if there's a storm and the sails are being blown off the mast, we're going to limp into shore a year later and get a new mast, maybe a new sail. And that's really the best way of describing it.
I love the sailing reference, especially after being in the Navy for 20 plus years. And I love the sail. Yeah. Awesome. Good reference there. So I want to talk a little bit about something, a trademark that you guys have coined, and that's synthetic equity, which I think we've been describing it and leading up to it. So if you could, hopefully, Bernard, you're good to go right now, but can you talk to me a little bit about synthetic equity?
Sure. 14th time is a charm, right? Like my hands are here. I'm not touching anything. So the term synthetic equity, we came up with that because what we're doing is we're trying to synthetically recreate the returns of equities. In this case, the S&P 500. And we're doing it we've explained how we do it. And the term is we want to try and get those big returns. That's the whole point of this exercise. And if you look over a market cycle, we expect to possibly perform and possibly even outperform the S&P over a market cycle. And by a market cycle, there's got to be some down years in there as well. Not to say we can't outperform even if the market just goes up. But again, I don't want to make anything that sounds promissory, because that's certainly not the intent of this exercise. But it is the idea that we are synthetically long the market. And because we're doing it synthetically, you have limited loss. And so with a limited loss strategy, it's this back that asymmetric risk reward thing. And we're doing it. You don't even have to hold the individual positions. Now we're just counting on the index to do its thing. So we don't have to hold the positions. So it's a synthetic exposure to the markets.
I would jump in and say that when you look at Warren Buffett, or a lot of people will just say young people, all they need to do is invest in a low-cost S&P 500 fund, VOO or SPY or somebody, and just put away money and continue to put away money for a long time, and you'll be fine. And it is fundamentally correct because it does have an excellent long-term track record. But there comes a time of age where this same marvelous index has the capacity, as we've discussed, to lose like half of its value. Mm-hmm. And that really is the only flaw in my mind, is that there is this huge risk component. And if it were not for that, I don't think there'd be much need for financial advisors, because you would just put your money into the long-term success of the American biggest 500 companies and ride that tide. But there is that one flaw. And so this synthetic approach is attempting to engineer out the worst of it and still leave enough volatility, enough risk downside exposure that we don't completely gut the potential for it to make us money. So we're still investors. We're still risk tolerant. We're not risk averse. We're risk tolerant, but we're not risk fools. We don't want to just bet the farm on this thing. So by synthetically recreating our structure, we're able to engineer out that deep drawdown.
Yeah, that's a very good point, because you can invest in something like VOO your whole life and say, yeah, it's doing great for me. It's doing great for you. And then when you actually go and retire, that's when it dips. Yep. That's when you lose 30% of your portfolio overnight. And you're like, what happened?
Right, exactly.
A natural disaster or a pandemic or something. Like
anything.
I can't imagine for all the seniors that were actually retiring in 2019 and 2020, how devastating
Yep.
COVID was for them as well. Not just because of their older age, and if you caught it, it wasn't that very good for you. They were losing the farm. But I think that's a really good way to look at it. And I think it is about managing risk, and you don't have to be risk adverse, but you have to be mindful of it. And I think that's where a lot of people get caught up. And as they get older, they say, I just want to be completely risk adverse. And that's fine. If you've got yourself to where you need to be, then go ahead and put everything in bonds and you'll be okay. There's some people that still want to make those gains, and this is a very good way to do it.
Yeah, we've come to the conclusion that we think it's the best approach that gives you a measurable way of knowing what your risk is before the event is occurring. And we don't know what is going to be the next thing. You know, we couldn't have planned on a pandemic. We won't know what is going to cause the markets to suffer its next big, gnarly. 15% is not a small number, but it's a number that's survivable because the S&P goes up more than, let's say, 18 to 20%, remarkably, like more than a third of the time. Yeah. So if you look at a distribution pattern on the S&P 500, it's not like it goes up 25% once every 15 years. It hits over 20% more than like 30% of the time. So that's right. That distribution of returns is very strong and very high, and we want to participate in those. And then we don't want to participate in what is frankly an occasional minus 40, which is a problem. But the real problem in my mind is the number of advisors and the structure that puts 30 or 40% of a client's portfolio into the relative safety of bonds, permanently dumbing down the performance that can be achieved in the S&P 500 for many years that are not necessary. And that's the part that we're trying to build something that can improve that outcome.
Yeah, that's fair. Okay, so speaking of synthetic equity, right, you guys have the trademark for it. You also have your own ETF.
We do.
So can we talk about that really quick? I know we've been describing it this whole time. Yeah. So can you talk about that?
Sure. I'll have a go at it. We launched the ETF fund back in March, and March 11th, I believe. The symbol, believe it or not, is SNTH, which is an abbreviation for synthetic, and of course the word equity. It is linked to the S&P 500, and we're buying options on the S&P 500. The holdings in the ETF it's publicized every day, so people can see through the transparency of the ETF that the bulk of the money is in government bonds, and it's about 81% in government bonds, and then there's a couple percentage points in cash, and the rest of it's in the options that we actively manage. And the cool thing was we listed it on the New York Stock Exchange, and as a result of that, we had the opportunity to actually ring the bell there, which was quite a unique experience in and of itself. But launching the ETF was definitely a very big decision for Larry and I, and it's been just an incredible experience. It's been amazing just to watch it grow.
Yeah, actually, so I know we talked about this pre-recording. What was that experience like ringing the bell?
Oh, I'll let Larry take this one.
Yeah, we had an interesting experience because a few months earlier, we had been invited to ring the closing bell at the CBOE, the Chicago Board of Options Exchange, because we do a lot of options. For the size firm we are, we're not a huge firm, but for the size firm we are, we punch above our weight class in the amount of options we trade. And as a result, we went there and we talked about who's going to ring the bell, and Bernard was super enthusiastic about it. So he rang the bell at the CBOE. And I said, listen, I'll ring the next bell. And we hadn't even decided to launch an ETF at that point. So there was no pending bell ringing at all to speak of. And we got approached by an ETF manufacturer. We started to look at it pretty hard. We realized we actually could put this thing into a public wrapper and get it out the door. So we decided to do that. And part of this process is engaging with the New York Stock Exchange and the NYSE to help promote the launch of it. And so we get invited to ring the bell. We have hardly any notice, like I think it was 9 days or something from you're invited to or you're doing it. And this whole time, obviously, I'm going to ring the bell because that's what the arrangement was. Bernard starts to have doubts. He was really FOMO, like severely. I remember
it's true.
Yeah, coming in to the office on the day before we're going to fly out to New York. And I think we can both put our hands on the bell and ring it at the same time. I'm looking at him like, we are not going to be handsing in front of millions of people on TV. And the answer is no. And I'm ringing the bell. But I knew how important it was to him. So as we get to the event, this is just a mind blower because you get to the New York Stock Exchange and there are people outside taking selfies because it's just an iconic place. And to have our company name, Measured Risk, up on all the LED billboards on the outside, and then go inside and be plastered with us basically, and to be in the same place with big name brand companies that are household names was just fantastic. But we get to the meat and potatoes of this exercise, and we're going to be going down, and you have to sign the book, and the person who's going to ring the bell is the person who signs the book, and there's no two signing stuff going on. So I took the pen and I handed it to Bernard and say, "Ring the bell, Bernard." And
sign the book, you mean? Sign the book.
Sorry, yeah, sign the book, Bernard. So I'll let Bernard take it from there.
Oh my God, Mike, I was so shaky that Larry said that at that moment, because you're standing beneath the actual bell itself, and you're at this podium, and there's the book, and I'm standing at the book, and the guy his name is Tim is helping us. He's the guy from the NYSE coordinating the whole thing, and he starts to page through the book, and he shows us that everybody uses this pen except one person used a marker pen, and it was obviously President Trump who used the marker pen, a big black marker pen, to sign his name. He shows that to us, and then at the very last moment, there was not another moment to go, and Larry says, "Sign the book." And I'm like, "Larry, if I sign the book, it means I got to ring the bell." He goes, "That's right, you're ringing the bell." I'm like, I became so shaky. My signature is just a mess. I couldn't believe it. It was, and then to actually go upstairs, and you go up the stairway, and on the wall, everybody who goes up on the podium gets to sign the wall on the way down. And so it's only one flight of stairs, but it's lots of signatures there. And I imagine they changed those panels out because there's just obviously not enough room for everybody who's ever done it. But to be up at that podium looking out over the NYSE floor, and as Larry pointed out, and seeing our company name and logo, and it was so surreal and so humbling, and just such an appreciative moment of just, wow, here we are. It's truly incredible, just incredible. And it was everything it's cracked up to be, and a whole lot more. So I'm super appreciative of that opportunity. And
that's awesome.
I'm super happy Larry said, "Ring the bell." And I didn't see it coming. I told him, "You just really banged me. You messed me up in a good way."
So Larry, awesome. Very humble of you, for one. For two, I want to say, when you were in Chicago, I would say foresight, but I'm going to say premonition. Like your premonition to say, "Oh, I'm going to ring the next bell." Yeah, was pretty good, and then you gave that up for Bernard, and that's awesome. That's awesome.
Yeah, there's a little part that I don't share, and Bernard's going to hear it. But I was paying attention to Tim, our ambassador at the NYSE, and he said, "So the bell rings 15 seconds before the close, and it's actually the warning bell. The closing action is the hammer, and the gavel basically, and the gavel is brought down not once or twice or four times, but three times, and bang." I'm like. So I'm thinking to myself, I think I want to do the hammer, the gavel. so that's what I did. So that's awesome. The part that I took. So
it worked out for both of us. I was elated. Larry was clearly elated. And it's all good.
It was all good.
It was awesome.
That's awesome. Hey, I really appreciate that story. I think this has been awesome. I feel like there's been so much value shared in this interview today, and just hearing your background, your story, what you're doing with synthetic equity and the ETF that you started back in March. It's just all super amazing. And then to hear your story about going to the NYSE and just the experience of it, gave me goosebumps. So I think that's really awesome. So I really appreciate all of that. I'd like to now transition this into something I call the final round. It's where I'm going to ask you both the same 4 questions I ask everybody that comes on the show, and we can alternate these questions. But it gives us a better idea of how you guys are under a little bit of pressure, but it's really not that bad. So if you're ready to go, I'll start.
All right.
All right, let's do this. All right. First question of the final round is, what's the biggest mistake you've ever made when it comes to your finances or business life?
I'll take that one. For me, it was 2008. Even though I had talked about the market dropping 50%, in that year when the market was down about 30%, that is the point at which I put a lot of my own capital into an engineered product that was designed to go 2 times the direction of the S&P, because I was confident that's as bad as it's going to get. And wow, that watched really a tremendous amount of my capital vaporize over the next 4 to 6 months. It was me not respecting even my own knowledge, my own premonition earlier of how bad the markets could get. They can get way worse than you can imagine. And I didn't respect that properly.
Yeah. I'm going to say a big mistake that I think we made is not being bolder earlier, not being bold enough earlier in our careers. I think that's But here we are, and this is awesome.
Yeah.
Yeah.
Okay.
Exactly.
That's fair. Awesome. So the next question, these kind of tie into each other, is what is something that you've learned that you wish you knew when you first started out?
Wow. Yeah. For me, it would be challenge, popular conventions. It's okay. Don't accept the way it is. There's a better way of doing things. Look for them, go for it, and be bold about it. And I think Larry and I have embraced that.
Yeah, there was somebody who taught us an expression. I'm not sure who I can attribute it to for its common knowledge, but the expression was different isn't always better, but better is always different.
Yeah.
Because you can't expect better doing the same thing.
I love that. Yeah, that's a great saying. That's really
Mhm.
good. I like that. Okay, awesome. So the next question is, do you have any tips or tricks that you would recommend to someone that is just getting started today? Brand new investor, what would you tell them?
Yeah, for me, I would say this: options are the Swiss Army knife of investing. And as a financial guy, we have to go through most people in this business have gotten a Series 7 and taken that exam to get the license to be able to trade if you're a professional. About a third or more of the exam itself is on options. And then you graduate, quote unquote, and get assigned to a firm. And invariably, those firm supervisors don't want you going anywhere near options because of the potential risk that they present. But for me, I've thought about this. If I were starting out, I would definitely learn about options, understand how they can turn risk into unbelievable risk, but also how they can manage risk and contain it. Because an option is just a contract that flips money from one person to another under terms. And if you understand those terms, you can turn $100 into $1,000. You can also lose $100. And by the worst token, you can collect $100 and lose $1,000. And that's the side of the trade that gets options a bad rap. So for me, I would spend education on how options can be used to create leverage, and that leverage can literally move your finances in a direction much faster than you would imagine.
Yeah.
Awesome.
Two things I want to add here. The one is I'm just disappointed at the lack of financial education that is given at the school level. It's just, it's shocking to me. You'll learn so much about this and that. And the most fundamental thing to all of us, which is education for when you're young enough to appreciate 14, 15, 16-year-olds, that there should be courses in schools doing basic financial understanding. But with that being said, and that's my soapbox item, I think if you're starting out today, I'm presuming you're younger, do more. Put as much as you can away, because the reality is as life goes by, your expenses get higher. It becomes more difficult to invest. It doesn't get easier. So if you're a young kid starting out and you don't make a whole lot of money, the reality is you're probably going to be able to save the biggest percentage of your income right now. And if you can set up those habits when you're young, it's going to bode so well for you, just letting the compounding take over. Larry and I, we discuss this all the time. It's the first $100,000 is the toughest thing to achieve. But once you get there, it starts to compound. It's a magnificent thing to witness. And then, of course, time is on your side. But just do more. If you're thinking of putting 10% into the company 401k, do 15. If you're thinking of doing the Roth IRA for $50, do it for $150. And you'll find a way.
Well, imagine in schools or in like young society, you could have a cultural change where instead of saying, I just got the new Nike Air Jordans, you can say, I just managed to get my first full share of NVIDIA. And that would be awesome if we could have that be something that 12-year-olds and 16-year-olds are trying to achieve.
Look, in the interest of self-promotion, I'm going to say I just got my first 100 shares of Synth.
Yes, exactly.
There you go.
Exactly.
Awesome. I love it. All right. So final question in the final round is, do you both have a favorite business, investing, or real estate related book or podcast, or both?
Yeah, The Richest Man in Babylon always comes to mind.
That is just one of my favorite books on personal finances.
Yeah, it's just such an easy read. It's so quick. It's so easily to grasp the concepts. There you go. Exactly. And it's written, it's not using fancy terminology. It's a story, just a story in it. But there's great lessons in this. I would highly recommend The Richest Man in Babylon.
Love it.
For me, it's actually a little off point, but it's by Donald Miller. It's the Building a Story Plan. And that's an exercise in finding your why and understanding what it is that you bring to the table, what problem you are trying to solve, what's going to make you motivated in the morning to wake up and try and continue to slay that dragon, and then how to actually communicate that to your audience. And I think that was a really instrumental book that I was encouraged to read just a couple of years ago.
I love that. Awesome. Thank you so much for that. That is it for the final round. You can pat yourselves on the back. You made it through.
Nice.
Wasn't that bad, but I really loved your responses to every question. That was fantastic. And again, providing lots of value to the audience right now. So that's amazing. So now I do have another question I want to ask you. And this is the most important question of the entire podcast, because for my listeners that have been tuning in right now, they're like, I feel like I've learned a lot about synthetic equity and how to manage my risk a little bit better and be a little bit more aggressive. So some of them are probably thinking, I want to know more. Where can people find more information about the both of you? Can you share your website with us or any social media profiles people can follow?
Yeah. So measuredriskportfolios.com, just spelled out, is the firm. That's where we manage private assets. And then we have the ETF specific fund, which is synthequityetf.com. And that's SYNTH EQUITY ETF.com. And between those two places, or even LinkedIn has the Measured Risk Portfolios site, there's plenty to be learned there.
Awesome. Okay. So I'm going to make it easy for our listeners. Those links will be in the show notes. So you'll be able to check those out and check it out on LinkedIn as well. But you guys know the drill. If you're driving right now, please don't try to do it while you're driving. Get to a safe place. And hey, so Larry and Bernard, to close things out, do you have any final thoughts for our listeners today?
Yeah. My final thought is take action. Do stuff. Time goes by, do stuff. That's my advice.
Indeed. This is not a dry run. This is your life, and you need to put your shoulder to the wheel and push hard and enjoy yourself. I think I read something recently that if you're not actually experiencing a little bit of discomfort and fear, then you're not going toward the place you need to be.
I love it. I love it. So it's all about managing your risk. It's all about managing your fear, right? And moving forward. So I really appreciate that, guys. This was, again, like I said, fantastic. Lots of value. Thank you so much for taking the time out of your day today to join me and our guests and share this wonderful information. I really appreciate it.
Thank you, Mike.
Thank you very much, Mike.
Absolutely. And I
by the
also
way,
want to say,
sorry.
go ahead, Bernard.
I just want to add one thing. There's a quote I stumbled onto, and I just want to share it with everyone.
Sure.
It's success is not final. Failure is not fatal. It's the courage to continue that counts. And I just I just love that. But anyway, sorry, I didn't mean to cut you short.
No, awesome. Hey, again, thank you so much. And I also want to thank all of our listeners for joining us today and joining our special guests on the Average Joe Finances podcast. Go leave us a 5-star review and tell us what you liked about today's episode with Larry and Bernard. Aloha from Hawaii, and have a great rest of your day. Thank you for making it to the end of this episode. Greatly appreciate you being here with me today on the Average Joe Finances podcast. If you haven't done so yet, make this the episode that you go leave us a 5-star rating or subscribe to our YouTube channel. The Average Joe Finances podcast is for informational and entertainment purposes only. Have an outstanding day.